People say one ETF is all you need. Just buy BWCE and chill. But for many people here in Europe, that is bad advice. Over my 18 years in finance, I've invested hundreds of millions into ETFs, and I've trained over 8,000 ETF investors. In this video, I will show you that there is no single ETF that fits everybody in Europe. And understanding the reasons why will make you a much better investor. Now, don't get me wrong, a single ETF can be a good investment. Take VWCE, the Vanguard FTSE All-World UCITS ETF accumulating, which everybody recommends online. With just a few clicks, this ETF puts your money into 3,800 stocks based in developed and emerging markets. It covers many different industries. You get a tremendous level of diversification. It only costs 0.19% per year, and it has earned over 11% per year over the past 5 years. And all of that is wonderful. For many people in Europe, VWCE could be a fine choice. But for many others, it could be an expensive mistake. And the first reason is taxes. VWCE is great for taxes in many countries like Latvia, where I live. But in other countries, it is suboptimal. In Spain, for example, index funds have tax advantages over ETFs like VWCE. In Switzerland, investors have access to US-based ETFs like VTI, the Vanguard Total Stock Market ETF, which also have some tax advantages for Swiss investors. And then in Denmark, ETFs like VWCE get taxed every year when the price goes up, even if you don't sell. But there are certain local index funds available which don't have this problem. Basically, every country in Europe has different tax rules, and that is the first reason why there is no single ETF that is best for everybody. To explain the second reason, which is equally important, consider Anna and Bob. Anna is a 25-year-old marketing specialist with no kids, no savings, and the ambition to retire early at 55. Bob is a 70-year-old retiree with 700,000 Swiss francs saved up. This money needs to last him another 2 or 3 decades. So, would you say that Anna and Bob should have the same identical investment portfolio, just VWCE and chill? Well, clearly not, because this advice ignores your age and it ignores your willingness to take risk. For a young, ambitious investor, putting 100% of your money into global stocks could be smart, but for a retiree who is spending down their savings, or for a young investor who is nervous about market movements, it's a bad idea that could lead to catastrophic mistakes, like panicking when the market drops and selling at the worst possible time. In fact, many investors should have at least 2 ETFs in their portfolio, a stock fund and a bond fund, so they can adjust the risk level as they get older or as their risk tolerance changes. Now, the third reason to be careful with VWCE and chill is Donald Trump. But before I explain why, here's a quick note. If you live in Europe and you'd like to start ETF investing and you'd like to do it in a responsible way that takes into account your age, risk tolerance, and tax situation, you're actually in the right place because that's what I cover in this channel. But if you'd like an easier way to learn, with all the skills that you need organized step by step and me standing by to answer all your questions, you might enjoy the Index Masterclass, my training program for European investors. To find out more, just follow the first link in the description. Okay, but here's the third reason to be careful with VWCE and chill. If you buy a global stock ETF today, around 60% of your money will get invested in the biggest stock market in the world, America. That means more than half of your savings will get invested in big American companies. You will face a lot of currency risk between the dollar and the euro or pound or Swiss franc, and you'll be exposed to the decisions of the stable genius in the White House. Now, historically, American stocks have been unbeatable, and that might continue. But just last year, Trump threatened to put extra taxes on European investors, and this year he's been threatening to invade Greenland. Looking at all of this, many European investors are justifiably nervous about investing most of their money in America. And if you would like to reduce your exposure, you will need more than a single global ETF. Now, full disclosure, I personally have not reduced the US exposure in my ETF portfolio. Why is that? Well, it's because of the fourth reason why one-size-fits-all investment advice doesn't really work. And to illustrate this reason, meet Emily and Carla. Emily runs a furniture export business in Portugal. 80% of her company's clients are American. Emily has savings worth 500,000 euros, and because she is very busy, she prefers passive investments. She wants to put all of her money into ETFs. By contrast, there's Carla, who's a lawyer in Lisbon. She also has savings worth $500,000, but she's a passionate real estate investor. 400,000 euros of her savings are locked up in several rental apartments. Carla is planning to invest the remaining 100,000 into ETFs. Should Emily and Carla buy the same global ETF? Well, maybe, but probably not. Through her business, Emily is heavily exposed to America already. If there's economic trouble, or if Trump increases tariffs, or if America and Europe get into some kind of fight, her business will suffer directly. So for Emily, diversifying away from American stocks could make sense. By contrast, 80% of Carla's wealth is tied up in Portugal. Only 20% of her wealth will go into ETFs. And in her case, having a US-heavy portfolio is probably not a major risk. Carla's case is kind of similar to mine. I don't own real estate, but I have significant business interests here in Europe, and that's why I'm comfortable with investing in a global stock ETF, even though 60% of my ETF portfolio goes to American stocks, because ETFs are only part of my family's wealth. Okay, so that's the fourth reason to be skeptical of simplistic investment advice. It ignores your personal assets as well as your personal risks. Now, the next reason is a big one. The thing is, if BWCE and Chill were the only possible investment out there, many people would refuse to invest at all, because this means that part of your money would go to weapons companies, part of it would go to oil and gas companies, part of it would go to tobacco or gambling companies, and so forth. Many European investors don't want any of their money going to these industries. Now, to be clear, there is unfortunately no evidence that avoiding such investments has an impact on how companies behave. In fact, it seems to make no significant impact. And for this reason, I use a global stock ETF myself. But for many investors, this is a non-negotiable moral issue. Unfortunately, there are socially responsible ETFs available today, which screen out companies based on various environmental or social or governance factors. Finding the right ETF to match your personal goals and moral values can be a little bit tricky because everybody defines social responsibility a bit differently. But it is doable. And for many people, this is what enables them to invest at all. So that's the fifth reason why just one ETF is not all that everybody needs. Now, the sixth reason is practical. It's all about encouraging competition in the ETF market. VWCE in particular is no longer the lowest cost global ETF out there. In fact, it's not even the lowest cost ETF tracking the FTSE All World Index. Invesco has launched a couple of ETFs with a total expense ratio of 0.15%. Versus 0.19% for the Vanguard fund. And State Street has the Spider MSCI All Country World UCITS ETF with 0.12% per year, which tracks a similar index from index provider MSCI. I'm not saying these other funds are necessarily better, but they're certainly worth considering. And then we come to the seventh problem with giving advice like, just buy this one ETF and that's all you need. For me personally, this problem is actually the real deal killer. And to illustrate it, let me tell you about my friend Giannis. This is a real story. So 20 years ago, Giannis became a millionaire through selling his engineering company. He wanted to invest, so he asked his banker for advice. The banker recommended a few investment funds, and Giannis promptly bought them. This was around 2006. He put around €500,000 into the market. Then 2008 hit. The big financial crisis started, and the market crashed. Soon, Giannis had lost several €100,000. He was devastated and scared that he would lose even more. So he sold his entire position, called his banker an idiot, and stayed away from investing for the next 10 years. Now, whose fault was this? Did Giannis's banker give him bad advice? Well, the specific funds the banker recommended were probably too expensive, but that's not why Giannis lost money. If he had stayed calm through the big financial crisis, if he had left his money invested until today, by now it would be worth 5 times what he invested. The problem was that Giannis followed the recommendation without any understanding of what he was doing. And this, more than anything else, is fatal to investment success. If you want to succeed with saving and investing, the real problem is not which ETF to buy. There are some tax nuances and technicalities that you have to think about, but all of that is solvable. The real problem is up here between your ears. How will you react over the next 10 or 20 years as the market goes on a roller coaster up and down and up again? Will you make smart decisions that grow your wealth? Or will you sabotage yourself by buying high, selling low, panicking in crashes, getting overexcited in bubbles, and making all the other classic mistakes. So that is why I'm not a huge fan of one-sentence investment advice like just buy BWCE and chill. Based on 18 years in finance, I sincerely believe in the value of knowing what you're doing. So if you're a busy European who would like to invest, but you're new to this and don't know where to start and don't want to make expensive mistakes, then I'd love to help. You can watch my YouTube videos, or if you'd like to make progress faster, I've got a step-by-step training where I take you through everything that you need to know in order. Plus, I'll be there to answer all your questions along the way. So if that's interesting, just follow the first link in the description to find out more.